Okay, so how many of y'all have seen people post this type of charts around the internet where they take historical prices of your favorite coins and draw some seemingly random lines and use that to predict that at this point in time in the future, the price is going to shoot up to the moon? You may sit there and think that these people must be crazy, or at least huge jokers. Well, they might be jokers if they're including pictures of rocket ships or the moon in their drawings, but actually, what they're doing is known as technical analysis. And the gist of this is that they're trying to use historical price data to forecast future price movement. You may still think this sounds like a lot of fortune-telling voodoo magic, and I used to think the same. But as I took a deeper look into it, it's actually based on quite a bit of logic. And so without further ado, I want to introduce to you my multi-part video series on technical analysis for beginners. Now this needs to be a multi-part series because there's just too much information to cram into one video. So if you're interested in seeing the other ones, be sure to click subscribe right now to catch them in the future. So it's actually not voodoo magic. It's actually a tool that's potentially useful for short or medium term trading. It's based on a lot of mathematics and human psychology. The three main assumptions are that the market considers everything when determining the prices move in trends, and history repeats itself. This may seem a little bit vague, and I'm not going to go quite into detail into these, but be sure to Google technical analysis assumptions or look into the Dow theory, that's DOW theory, for more information. And so to kick this all off, this is where all the magic happens. That's your typical trading view, which shows you historical price movement and the current price. And so you have the order book, which shows you currently what the buy orders and sell orders are. And you see the price chart of a certain time span. Candlesticks are what these are called. Moving averages, volume, and your choices for different time frames. So just diving in, the first thing we have to look at is candlesticks. And what this does is basically consolidates your price movement in a given time period into a compact form. And so, for example, if you select 10 minutes, the price may start here and go up and down like crazy and reach a high point. Let's say it starts at 5. Sometime it reaches the high point of 7, goes all the way down to 1, and then ends back at 3 at the end of this 10-minute period, okay? This is what the candlestick would look like. It's red because it closes lower than it opened. Started at 5, ended at 3 during this time period. And the high is 7, the low is 1. Similarly, if it ends up higher than it began, then it's green. Sometimes the colors are different, like black and white, but you get the gist of it. Also, so depending on the price data during that time span, these candles can look way different. This can be shorter, it can be one-sided, it could be really long, the tail, and the body could be like short, for example. And what you need to really look for here is patterns. So you don't look at one by itself. You look at how they line up with their neighbors. And there's some common patterns that have names. You can take a look here. And the concept behind this is that if you see certain patterns, there's a higher statistical chance that something is going to happen after you see that pattern, either go up or down, or maybe stay the same, depending on the pattern. This is based on looking at a wealth of historical data, and if they see these patterns in the past, more often than not, something's going to happen, like go up or down. Moving averages is also a very important part of your chart. And what they do is they help you look at trends, like long-term trends. Is it trending upwards, downwards, or sideways? And there's different time periods for moving averages, and also exponential moving average and simple moving average. Exponential following rapid price changes more closely than simple averages. But basically, they help you look at the overall direction of the market. Okay, now in terms of chart, time frames are also very important. They usually have a drop-down menu to let you see the time frame of like the candlesticks, for example. And how to choose this is really important when doing technical analysis. Basically, you want to ask yourself, how long do you want to have a trade open? And so if you're doing a short-term trading, you want to do a short-term view, usually around 15 minutes to an hour. And the concern is that any lower than 15 minutes, it might be a lot of noisiness if like there's not enough volume or not enough trading going on. Like one person's trade can just like go crazy with the chart. So you want to zoom out a little bit. Also, if you're doing slightly longer trading, like holding it for a few days or a few weeks, for example, you might want to do a more macro view, and that's like 6 hours to 1 day for your settings. And the concern is that if you do even higher than that, the chart is going to miss a lot of important details. Like you're going to miss a lot of peaks and valleys that might be important to your technical analysis because it's zoomed out way too much, and all of that peaks and valleys is consolidated into one candle. Another thing that we saw earlier in the trading view is volume. And what this does is it basically tells you how confident you can be of a certain like direction change of the price. For example, if things are going up or down, but the volume is not large, then that might not mean as much as if it was the volume was very high at that point in time. And the volume is, you can usually like hover your mouse over it and it'll tell you like the amount in like US dollars that happened during that time period. And here you go, just the green and red kind of mean similar things to the candlesticks. The closing was higher or lower than the previous period. The order book is a always present part of the trading view. It basically tells you the price of the coins and how much people are willing to buy or sell at that certain point. Now I mentioned the order book because the depth chart is a visual representation of this. And it basically gives you a visual way to look at supply and demand at various prices. Like you can see big buy walls at certain prices or sell walls. Now usually this would mean quite a bit, but in crypto things are unregulated, so people can do bots that kind of like put in these buy walls and sell walls and also take it away at a blink of an eye. So it's not really too useful, but in traditional trading, like the stock market, it is, because people can't do that, put it in and then take it out at the last second before the price hits that wall. And so I just wanted to tell you about this anyways. Okay, everybody, so that's it. I hope this was helpful. Definitely stay tuned for my next episodes of Technical Analysis for Beginners coming real soon. Please give this video a thumbs up, and I'll see you on the next one. Peace out.